Silver investors, the screen looks calm today, but under the hood, China's silver market is screaming emergency, while Western traders pretend nothing's happening. Global prices have cooled off after that insane $120 to $70 round trip. But inside Shanghai, contracts for immediate delivery are trading at record premiums because there simply isn't enough metal to go around. I'm OG John AG, and in this video, I'm going to show you why China's silver squeeze did not end with the last crash, how record backwardation on the Shanghai Futures Exchange proves the shortage is real, why short sellers are literally paying penalties just to avoid delivering metal they don't have, and what it means for you when the world's biggest refining hub is out of silver even while your app shows a calm price. Segment 1. Calm surface, squeeze plumbing. On the surface, the silver chart finally looks boring again. Internationally, prices have stabilized after that epic spike above $120 and the brutal sell-off that erased most of the gains. If you just look at that daily candle, you tell yourself, okay, volatility's over. The bubble popped, back to normal. Inside China, that story is completely false. FX leaders and Bloomberg are reporting. Domestic producers and traders in China are facing a backlog of orders they can't fill. Investment and industrial demand have drained stockpiles to the lowest levels in over a decade at Shanghai-linked warehouses. The front-month silver contract on the Shanghai Futures Exchange is trading at a record premium over later months. That's not calm. That's a system running out of breath. Segment 2. Record backwardation, when now is worth more than later. In a normal metals market, later month contracts trade a bit above spot. You pay a carry cost for storage, insurance, financing. That's called contango. Right now in Shanghai, you've got the opposite. Backwardation, so extreme analysts are calling it an inventory crisis. FX Leaders lays it out. The front-month SHFE contract has surged to a record premium because everyone wants prompt delivery and there aren't enough deliverable bars. Sichuan Tianfu Bank's senior analyst Zhang Ting says this large backwardation is driven by an inventory crisis and the depletion of deliverable material. Translation, the market is screaming, give me metal now, I don't trust paper promises for later. You don't get that kind of curve shape in a market with plenty of supply. You get it when stockpiles are gutted. Buyers don't believe future deliveries are safe. Shorts are scrambling to avoid having to show up with bars. Segment 3. Short sellers paying to not deliver. Here's the most bullish silver sentence you'll hear this month. Short sellers on the Shanghai Gold Exchange have been paying deferral fees to long holders to avoid making deliveries. Read that again. These shorts bet silver would fall. Price did crash, but instead of celebrating and closing comfortably, they're now paying the other side just to kick the can and delay settlement. Why? Because they can't get the metal, or they can, but only at such a high physical premium that it nukes their profits or creates huge losses. When a market is well supplied, shorts don't fear delivery. They just go into the market, buy the metal, and hand it over. When a market is squeezed, shorts become hostages. They're willing to pay long holders to roll contracts rather than face the music now. That is classic short squeeze behavior. It tells you the shortage isn't a Reddit meme. It's written into the fee structure on the exchange. Segment 4, 61% gain, 40% crash. But the squeeze didn't vanish. Let's talk about the roller coaster that got us here. FX Leaders notes, in the first weeks of 2026, silver ripped 61% higher, briefly turning into the go-to asset for people panicking about the dollar, Fed independence, geopolitics. In that frenzy, Chinese and global speculators piled into silver, treating it like a leveraged fear trade. Then came the crash after late January. A single historic sell-off erased most of that 61% gain in days. The lazy headline is, bubble popped, squeeze over. But what did the crash actually fix? Did it refill stockpiles at Shanghai warehouses? No. They're at 10-year lows. Solve the backlog of industrial orders? No. Producers still can't keep up. And the deferral fees from shorts? No. They're still trying to avoid delivery. The spike and crash cycle flushed out dumb leverage and weak hands. It did not refill the vaults. So now you have a calmer headline price. The same structural shortage underneath, maybe worse. That's why FX Leader says the big squeeze lingers despite price calm. Segment 5. China's export chokehold. Squeeze by design zoom out from this one article and layer in what China has been doing since January. FX Leaders and other reports laid it out a few weeks ago. China supplies 60-70% of global refined silver. On January 1st, 2026, Beijing scrapped its old quota system and imposed a strict licensing regime. Only refiners producing 80-plus tons per year can export. Smaller refiners, hundreds of them, are now effectively cut off from international markets. This does three things at once. Prioritizes domestic demand. Industry and investors inside China get first claim on silver. Chokes supply to the rest of the world, tightening global availability. Elevates silver to a strategic material status, similar to what China did with rare earths. Now connect that with today's news. Chinese inventories were already exhausted when this speculative wave hit. New export restrictions mean whatever silver is left is likely to stay inside the country. Backlogs and backwardation on SHFE show local demand is still overwhelming what smelters can deliver. This is not an accidental squeeze. It's a structural squeeze amplified by policy. Segment 6. Industrial monster versus calm price. The squeeze isn't just about investors. It's about factories. FX leaders and other outlets highlight silver is in structural deficit. Demand outstrips mine supply year after year, thanks largely to solar panels, EVs, electronics, emerging tech like AI hardware and 5G. Chinese inventories were already low when investment demand surged in early 2026. Domestic buyers treated silver as a hedge against dollar risk, Fed credibility, geopolitical tensions. Now industrial users are competing with retail stackers, speculative funds, export-restricted supply. FX leaders says producers are struggling to fill a backlog of orders, pushing up near-term prices. Another piece notes firms took advantage of the recent price collapse to buy the dip, further tightening prompt supply. That's the core contradiction. Your chart says, relax, silver is calm now. Chinese factories and refiners are saying, we're still short metal and will pay extra for delivery this month. When price and fundamentals disagree like this, price will eventually lose. Segment 7. What this really means for silver stackers and traders. So how do you use this lingering squeeze information? If you're a stacker, long-term holder, understand that this calm price is artificial. The same forces that drove silver above $120, structural deficit, Chinese demand, export limits, are still here. The crash mainly removed weak leverage speculators. Dumb money that chased late. It did not fix inventory levels, export bottlenecks, industrial appetite. So dips into a calm zone are not proof the bull market died, more like the eye of the hurricane. If you're a trader, respect the fact that the front of the curve is screaming tightness while the headline price looks chill. Don't assume backwardation will vanish quietly. It usually resolves via higher spot prices, or a blow-up where shorts are forced to deliver or settle at much worse levels. But also, volatility isn't gone. We just watched a 40% plus intraday swing recently. Squeezes can overshoot both up and down before settling. The smart move is not to predict the next 48-hour candle. It's to recognize the multi-month structure. China is squeezed. Exports are restricted. Inventories are at decade lows. Shorts are paying to delay delivery. The last crash scared tourists away, but didn't refill the tank. That is not what normal looks like. That is what a coiled spring looks like. You've been watching John AG here, and I'm OG John AG. If this helped you see today's calm silver price as a mask over a still screaming Chinese squeeze, hit like so this kind of under-the-surface breakdown doesn't get buried, and subscribe with all notifications on, because when that front-month premium finally blows out into the global spot price, I don't want you learning about the shortage from a mainstream headline after the move is already over.